And today's our guests are Adam Roberts and Emily Cortright from AE Multifamily. Welcome, Adam and Emily.
Thanks for having us.
Yes, thank you.
Yeah, absolutely. Thank you very much. And a little bit about Adam and Emily. They are dynamic real estate investors who have undergone remarkable shifts in money mindset and investment strategies throughout their entrepreneurial journey. They initially held prominent positions as engineers in operations and supply chain at GE, General Electric, and were climbing the corporate ladder with ambition. In 2013, they made a pivotal decision to venture into real estate investing, marking the beginning of their wealth building journey. Initially, they started with single family rental properties and also passive investing, then shifted towards multifamily syndications around 2017. So far, they have invested in almost eight in multifamily syndication as passive investors and eight syndications as active investors. Two have gone full cycles. So, with that, Adam and Emily, you want to add anything to your background?
Thank you so much for having us. Again, my name is Emily Cortright, and we have really enjoyed our multifamily journey. Like Rama mentioned, we started with single family, but even before that, we were both corporate engineers on the corporate track and realized very quickly that that was not the path for us. And so I left my corporate job first when we moved from California to Texas and pursued real estate investing in single family space. That got a little competition, got really strong in say 2016, 2017, we switched to multifamily, and we have loved the journey. And so we're really excited to share our story with you today.
Awesome. Thank you. Adam, you want to add anything on top of that?
Yeah, I worked my corporate job until 2018 when we started to acquire multifamily properties. And at that point decided it was time to join Emily full-time. And we've been both full-time married couple working in real estate as investors since.
Awesome. So, what are some lessons or some good things or not so good things from your multifamily journey or single family journey so far?
Yeah, I would say on the positive side of the multifamily journey has been the ability to really add value to the properties. That's something that I think as we have approached the current economic cycle has become more difficult to do. But 3-4 years ago, we were able to acquire multifamily properties with a true vision for value add and the ability to improve the communities for which people lived, as well as make money for investors. One specific story that I just love to tell because it was such a clear value add strategy that happened really, really quickly was a property that we owned in Dallas between 2018 and 2021. We were touring the property prior to purchasing, noticed that a lot of the toilets and water fixtures were extremely old. We had like 3+ gallon toilet tanks in all the units. It was really eye-opening. Again, just kind of you could see where the value add could take place. We ended up, when we bought that property, a couple months in, we ended up replacing all the water fixtures and the toilets in particular to water sustainable, low flow, water saving fixtures. And before we did that, the water bill at the property for which we paid as the owners, and it was an all bills paid property, so the tenants did not share in any of the utilities payments or savings. The water bills were in excess of $20,000 a month at this property. And literally the month after we did all the water savings installations, that water bill dropped to about $10,000 a month. And consequently, the value of the property, because of our expense savings, the value of the property shot up like $3 million in 1 month. And so I always love to tell that story because when you're out shopping for an acquisition, you really have to see the value add. That was like right in front of our face on that property. So
my lesson learned going back, like you mentioned, we have invested passively in 18 deals at this point. But that sounds like a lot, but our goal was 3 deals a year. And it could range from 25,000 to 50,000, maybe a little bit higher investments. And so we have consistently met that goal. And now after 6 years, we're up to 18. But there has been one of the first deals we invested in as passive investors. We were so excited to get in. We saw the presentation. The presentation looked great. And the deal was about an hour and a half from our house. And we did not go drive by it. And looking back, it was in not a very good part of town. And obviously the presentation didn't portray that. And I think if we had gone to look at it, we probably would have realized that the part of town was a little bit rougher than we thought. And that deal struggled. It ended up being okay. But that to me was a really big realization that I need to do a little bit more due diligence on my end, even when I'm investing passively. If that means taking the hour and a half to go drive by the property, maybe make it a day trip, and really making sure that I'm putting my money with the right people in the right properties. Because when times are good in multifamily, you might get 30 opportunities to invest in a passive investment per year. And if you say, I can only invest in 3 this year, I want it to be the best 3. I don't want it to be the first 3 necessarily.
Got it. Thank you. That means you invest only locally within 1 hour, 1.5 hour radius?
No, not necessarily. We have branched out to Georgia, to Colorado, but we prefer to invest with people that have boots on the ground in those locations. And so if I'm investing in DFW, where we live, Dallas, Fort Worth, I will go drive by the property and I'll make sure that there are boots on the ground with the people we've invested in here.
Got it. Thank you. So what are your top 3 criteria for as a passive investor?
First and foremost, it's the syndication group. It's the lead sponsor group. That's really the top one. Track record that they have, what types of investments they've done, and the returns that they've achieved. And so without a doubt, that's the first one. The second is the market, and even really down to the sub-market in the neighborhood. I want to make sure that, it's a market that's growing, population, job growth, things of that nature. Emily's point, want to make sure it's in a good part of town. It's a good, decent sub-market. And then third, it comes down to the numbers. I mean, at the end of the day, when passive investor, when you're reviewing opportunities, the numbers are always going to look good, right? It's not like someone's going to present a unfavorable investment. So as the passive investor, due diligence really concerns what's the capital stack look like, how much equity, how much debt, what type of debt are they using, what type of assumptions are they making about the market, rent growth, things like that. Like today, for example, the economy's been pretty tight. Obviously, we're probably going through somewhat of a recession right now. We're not seeing 6% rent growth. Probably won't see any rent growth next year. And so if someone approaches me for an investment that says, hey, we're going to assume 6% rent growth in 2024, well, then I'm probably going to disagree with that. And so, so third would be the numbers and the underwriting.
Awesome. Yeah, thank you for covering that. Awesome. So what are some not so good things or some lessons learned from passive investing side, active investing side?
Well, I'd say one of the bigger lessons learned that we've dealt with in our active investing are just some of the curveballs that can come up completely outside of your control. Property fires have been something that we've fortunately become very experienced in. Once you acquire a few properties, the chances of having a property fire in your portfolio go up. We've now had 3 over the past 6 or 7 years. One was not so large, and then we've had the other 2 that have completely destroyed buildings. And a lot of folks will tell you that the end result of a property fire is beneficial. You have a completely new building with new units and higher rents, and it definitely financially could be put you in a better position. However, the work involved to get to that point is what nobody really talks about. It's a substantial amount of work. We're finishing actually a property fire that occurred a couple of years ago. We are just now putting residents in units on that rebuilt building. And it's been just a significantly difficult journey to get that building built and insurance proceeds funded and all that. We had a fire last year at a property, and we've just now scrape the building. Insurance proceeds are still forthcoming. Still have adjusters coming out to visit the property with engineering companies. I mean, it's a whole process. And then after that's all squared away, we have to get city approval on architectural plans. And so all that to say, I'd say one of the biggest lessons learned is you just have to be ready with a good team in place, right? You want to make sure you have a great insurance team in place and a good adjuster in place. And you want to make sure you have good relationships with the city that you work in. I mean, that can really, really help cut down unnecessary delays in the approval process. At the end of the day, it becomes kind of a relationship-based journey where you're really hoping that folks work in your favor to get things put in place quickly, because you need to get the building built as quick as you can and get residents in there. So,
and that goes back to Adam's point, even with our passive investments, the topic of the leads being very important is because we've invested passively in deals that have had fires. And so we want to be confident that those leads can handle that kind of process too, even if they're new, even if they're partnered with experienced people, like who make sure that they are capable of dealing with some of the obstacles and the curveballs that are not expected and not in the underwriting that nobody wants to happen.
Yeah, thank you for sharing that experience. So can you give me like steps when you get fired on any of your apartments? What are the steps operators need to take?
on the fire units?
Yeah.
Well, yeah, first and foremost, it becomes a reconnaissance activity to ensure that residents are placed in either vacant units or neighboring properties. On this most recent one, I think our management company did a really nice job reaching out to neighboring apartment communities to see if they had any availability. And so immediately speaking, you're working to put residents in homes and get them the attention they need. And then you're securing the building. Usually we'll hire a contractor to come secure the building, make sure it's safe near the construction project, so to speak. And then you're engaging your insurance company and bringing an adjuster on to help manage that process. In the past couple projects, we've hired a public adjuster to kind of navigate and guide us through the process. That's been very beneficial. And so they really take control of the insurance aspect of it. And then once that's running, of course, you notify the lender to make sure they are engaged with anything that needs to occur, because the insurance funds usually flow through the lender escrow. And at that point, you're really at the mercy of the insurance company funding the activity to make sure that you're getting lost rent coverage and demolition disbursement and things of that nature. So it's really about the residents first, and then insurance company second, lender third. And at that point, you're really following the guidance of your insurance adjuster, who does this all day, every day. And so that's really the first couple steps.
Awesome. Yeah, thank you very much. So from lending point of view, are they adjusting any monthly payments, or how exactly is that?
With fire specifically?
Yeah.
So we had some conversations with the lender, because one of the difficult parts has been the lender has wanted to hold the insurance funds. And from our perspective, the insurance, that's the product we've paid for. We should get those funds immediately. And so we have had some issues with one of the lenders where they want to be the middleman, and they want to hold it just like they would capital expenditure money that they've put aside. And so we have had to negotiate with the lender, because like Adam said, I mean, their name is on the check too. So that has been another learning experience of the lender doesn't always just want to give you the money. They may put up a little bit of fight to keep that money in their bank account. And so again, relationships with your lender, with your insurance company are really important to make sure that that money can get to you in a timely manner and you can use it. Because we have had to front funds with demolition and setting up the fencing and securing the building way before the insurance money comes. So working with the lender is important. They have to be on board, and working very closely with them is important.
Yeah, awesome. Thank you. So what are the typical timeline to bring the units back to market? Yeah.
It takes anywhere from 6 to 8 months to demolish and finalize the architectural plans and get all the insurance proceeds in place, at which point you can actually start the construction project. And then typical 8 to 12 unit apartment building, it's a 6 to 8 month construction project, assuming no significant delays.
But we have, in the last one, we did have significant delays and issues, and it has taken almost a year and a half.
Yeah, we did. We ran into nationwide electrical meter shortage on the last project that held us back probably about 4 months. And yeah, so you're kind of at the mercy of the supply chain. Unfortunately, that fire occurred during COVID timeframe when supply chains shut down and we had a whole material inflation issue. And so you are at the mercy a little bit of the global economy, if you will. But yeah, assuming you don't have those issues, getting the building constructed really, ironically, is not it may not be the most time intensive process. It's really getting all the plans approved by the city and the insurance proceeds in place and all that.
Got it. Thank you. So let's switch towards current market conditions and also how exactly you are navigating. So what do you see in the current market from acquisition point of view, operations point of view, or capital point of view? Capital raising, yeah.
So from an acquisitions point of view, we have looked at we've underwritten probably only 3 deals this whole year, 2023. Our team we have 6 properties under ownership, and Adam will talk about the operations that we've done on those properties, but we have stayed heavily focused on the properties we currently own. And with the properties coming out, the spreadsheets just aren't strong enough cash flow for us and our investors. And so I'll plug in a property, and with the insurance in Texas, with the property taxes and with the interest rates, I might be only able to get the property to project a 4.5% or 5% cash flow. And the majority of our investor database doesn't want to invest for 4.5% to 5%. They can go get treasury bills, they can get high yield savings that can give them a guaranteed return at that rate. And so based on our passive investor pool, we have not bought anything in 2023, and we have stayed heavily focused on our current portfolio. And then with capital raising, in that same regard, we haven't had a capital raise this year, but I do know that a lot of our investors have kind of been a little bit more taken a step back and waiting, just because not all the deals are distributing right now. The fixed rate ones they're distributing well, but any deal that is a variable rate is probably not distributing. And so they're not getting the cash flows. They're a little bit more hesitant. And so that's what we've seen with our passive investors.
Yeah, on the operations side, I really think that obviously commercial real estate's been affected, to Emily's point, by the interest rate environment. I tend to think that the overall economy and the interest rate environment and what the Fed has done to kind of dampen the monetary policy, I think that has yet to really impact the everyday consumer. I think we're starting to see that a little bit. I know last month the jobs report came out, was not good. Inflation continues to kind of, stay steady, maybe tick down a little bit. But I think 2024, we are probably going to see some more of a recession type environment where, people can't really afford to spend the money they've been spending. In our portfolio and even amongst our colleagues, we're already starting to see a little bit of a softening in occupancies, and definitely a softening in rent growth, right? Coming out of the leasing season this summer, just have not been able to sustain the rent growth that we have the past couple of years, right? For most of our renewals, especially over the holiday season, we're not really increasing rents at all across the board. In fact, there's some properties in the portfolio that we're actually reducing rents to help maintain occupancies where they are. So that's really for us been the first sign of, I'll just call it consumer health, right? The ability for the apartment resident to pay more and more in rent to help, bolster our business plan. It's just kind of slowed down a bit. And, big picture, I think if we maintain our investment activities in high growth markets, markets that promise higher population growth over the next 3 to 5 years. Everything's going to be great. I don't think there's going to be any significant issues. We just need to stay mindful through this next, call it 12 to 24 months as we operate the properties.
Yeah, great. Thank you. So from operations point of view, so what steps you guys are taking to increase that or to maintain or increase NOI? Like now rent growth is like stable or, softening, from controlling expenses or, adding some additional income streams.
Yeah. I'd say two of the biggest activities that we participate in, and thankfully we've been doing this even before things have started to soften. Number one is balance sheet health, maintaining balance sheet health, ensuring that each property, each entity has, a stable amount of cash available so that, we can operate the properties for the next, we may be, headed for a big recession. It may not be so big, who knows? But balance sheet management has been something we've been heavily focused on over the past 2 to 3 years, just making sure we're prepared for this specific event. The second thing is, and this is really in line with our property management activities, ensuring that we have good budgeting and P&L control. Every 30 days, we go through a budget review on each asset, making sure that we're paying attention to the expense line items and taking necessary actions where we can. As it relates to leasing and occupancy, I do reviews with our management teams on where our marketing dollars are getting spent. Are we, going back to the grassroots marketing efforts, some of the free marketing, are we taking full advantage of that? And then every quarter, so 4 times a year, we will do more of a deep dive on, hey, some of our expense line items, which ones are the worst, right? Which ones are we spending, we're way over budget in certain areas, and how can we either fix that or reallocate budget? People, payroll's become kind of a very expensive thing over the past couple of years, but firm believer that, you need to pay for good people, right? It's important. If you're gonna exceed your budget in payroll, it might be for a good reason. So where can we kind of reallocate budget and be smarter to spend money where it makes the most sense? So really, balance sheet management and P&L management has been just crucial for us over the past couple of years.
And like Adam mentioned, one thing that we are focusing on is maintaining a good occupancy, like ideally low to mid 90s, because occupancy, having tenants there fixes a lot of other issues. And when occupancy drops, we've got services that we still have to cover with bulk Wi-Fi and things like that. And we're still paying utilities on vacant units. And so not letting that occupancy get out of control and drop too much has been a big focus, because having a 95% occupied property fixes a lot of other potential problems. Even if the rents, like Adam said, if you're not getting a rent bump, that may be okay, because it's better than going down to 85% and then you've lost all this potential income.
Yeah, and also like other thing is like especially turnover cost also increased, almost doubled in the current market, right? So what other steps you guys are taking to keep tenants in place or in the continuing renovations?
Yeah, we've been very creative with some of the rent specials that we've provided. That's probably been, I would say, one thing our management company is very smart about. Over the summer here in Texas, very hot. So over the summer, we launched a leasing special called Beat the Heat. And if a resident came in to tour a unit and filled out an application on the spot, we would give them discount on their rent based on whatever the temperature was outside. So August and September were absolutely brutal here in Dallas, Fort Worth. I mean, it was over 100 degrees every day. So anybody who was fortunate enough to come into the leasing office after 12 o'clock usually got a triple-digit discount on their lease rate. That really helped us keep our occupancies where they were. It added a little bit of fun for the leasing experience. I think, a little bit of gamesmanship for the leasing experience. Today, we are really focused on Google reviews and resident reviews, resident referrals. Word of mouth marketing is going to really get us through the holiday period. I am noticing ever since a couple months ago, we started a program where if someone felt so inclined to give us a positive Google review, we would give them a special on their application fees, right? We wouldn't charge them a full application fee. And and if people wanted to give us an honest 5-star review, it really helps the marketing process. We've definitely noticed more people come into the office to look and lease an apartment. And so just kind of the little things that may have a little cost here or there and really help bolster those metrics.
Great. Yeah. Thank you very much. And are you also doing any renovations or still continuing renovation process?
Yeah, we are. We're being a little bit smarter about it. I would say on the assets that we purchased last year, we still have a market that is interested in a full premium renovation. We're going to do those. What I'll say is we are not doing them at the same volume as we once were. I think what we're noticing in the marketplace is whereas maybe 80% of the potential apartment residents walking in the office would desire like a premium upgrade unit, that number has dropped down to probably about half, right? For every 10 people walking in the office, probably only about 5 are looking for something and willing to pay for something that's really premium. However, the good news is we're still getting strong rents for, I won't call it classic units, maybe lately turned upgrade unit is still getting a pretty strong rent. I may not be able to get $150 premium on that, but to Emily's point earlier, we're still able to manage a very good occupancy level while obtaining a good income for a specific unit. So we are seeing kind of a change in the marketplace there, but we're still doing upgrades.
Awesome. Thank you. So would you share any best experience so far, active side or passive side?
Best experience, kind of to Adam's point, building off of the water conservation example that he gave with our North Haven Terrace property. That property had a lot of other income opportunities. It was water conservation. We did reserved parking, upgraded units. We actually converted some of the 2 bedrooms with dens to 3-bedroom units. And we were able to sell that property within 3 years. And the passive investors got a 2.3x equity multiple. And so far that has been our best experience. And we have a lot of loyal passive investors from that deal, but it was because of Adam's market study that he did that realized we could do reserve parking. It was part of our due diligence with the water conservation. And it was really that other income and the interior renovations that boosted the property's value so much, we were able to sell it quickly and provide a great return for our investors.
Awesome. So would you also share any challenging experience?
Yeah, and I would say this, I'll give an example from our passive investing. And this goes back to kind of the points we were talking about earlier with what is the most crucial items to look at as a passive investor. We got into a couple deals early on, probably in the first year or 2 of our investing experience in multifamily. And we got into a couple deals here in Dallas, Fort Worth with a group that had acquired some properties. And again, to Emily's point, very excited about the opportunity. We looked at the underwriting, we looked at the location. We actually went and looked at these properties. So we covered our bases there, but we didn't put so much emphasis on the due diligence of the sponsorship team, right? They had some track record. They had other properties under management, but I can't say that I asked the right questions as it related to success of track record, returns, referrals from other investors, things of that nature. And actually, one of the deals did okay, didn't meet the projections of the investment. It did okay. And the second deal we got into with that group actually lost money. So took about a 30% haircut on principal. And when I look back and kind of examine that experience, really it comes down to that first point I made. How well did we know the sponsorship team? We knew them, right? We'd met them and networked with them and built up a small relationship with them. But I can't say that we really had a understanding of their complete track record, their complete resume, what type of deals that they had gone full cycle on, what type of success they'd had from that perspective, and things of that nature. So when I look at the root cause analysis, and this was back several years ago when people were doing quite well in multifamily, and I say, well, what happened there? And it was really just didn't take the time to study the sponsor team, the lead investor team. Didn't really do enough due diligence there.
Got it. Yeah. Thank you. What's your goals or next plans for next 18 to 24 months? How do you?
Well, so we have some properties in our portfolio that we have held for 3 years or so, and we are going to consider selling those next year if the rates drop a little bit and the numbers work out. And that would be, they would all be for great returns to the investors. And one of the reasons that we are interested in selling some of the good ones is because we want to be poised, us and our investors, to take advantage of potential opportunities that are coming on the market. So if there are going to be a wave of distressed assets that are on discount, on sale, we want our investors to be positioned to invest in those. And so we are going to consider selling some assets early 2024 for great returns, and then look at and really keep an eye on the acquisitions activity, the inventory that comes out, to see if those are properties that we want to take on. And I think that'll heavily depend on the lending that we'll be able to get on those properties. And but we will keep our eyes open, and we do plan to continue investing in multifamily because it's been a great asset class. And even this little dip in the market this year, last year, it's been, I think in the long term, the asset class will absolutely be successful.
What kind of asset classes you are targeting?
So we predominantly participate in the A and B class space.
Okay, so multifamily and B classes. Okay, value add deals, right? And let's switch towards personal side. So any habits that are helping you to be successful?
We have definitely paid for our education in the past. And Robert Kiyosaki has a great quote, and he says, formal education will get you a job, and specialized education will make you a fortune. And so there has been a few times in the past 10 years in our investing journey where we have paid for specialized education in investing. And in the long run, that initial investment in our education will make us millions of dollars in the future. And so I am a big believer in that quote and in that concept, because it has happened twice now with us, where we've invested in ourselves, we've invested in our education, and it's allowed us to grow our net worth, to help build our legacy and our generational wealth for our family. And so we absolutely support people who want to get educated on investing, because I think that's the best way to just enhance your own portfolio and make the smart decisions.
And any books that impacted your life apart from Robert Kiyosaki book?
Yeah, actually recently, in the past 12 months, as we've kind of made a little bit of a diversification in our investing, we read a book called The Banker's Code, and it's by an author named George Anton. That book, it's kind of a mindset book that speaks to investing in cash flowing assets like mortgage notes and other types of paper like that. Talks about being the lender as opposed to being the investor, the owner of the real estate. And so as Emily and I have kind of diversified over the past several months, that book was just absolutely phenomenal, well written, and really puts a few things in perspective as it relates to being the real estate investor, being the bank, being the lender, things like that.
Great, awesome. And how can listeners connect with you guys?
Our website is the best place, and that website is www.ae, like Adam, Emily, aeinvest.net.
Awesome. Thank you very much. I really appreciate it. Thank you for your sharing your experiences, both passive side and active side, and also your best and challenging experiences as well. Thank you very much. Really appreciate it.
Thank you, Rama. Thanks for having us.
Yes, thank you.
Yeah, sure.